Hello and welcome to this update for the Monks Investment Trust. My name is Spencer Adair and I'm the manager of Monks. Now in this short update, I'll provide a brief reminder of our investment approach, comment on performance, and explain why we're excited about the prospects of the portfolio in the years ahead. Monks seeks to deliver capital growth by investing in a diversified collection of what we believe to be the most compelling growth stocks anywhere in the world. We recognize that companies grow in different ways, and we embrace three earnings growth profiles, investing in a blend of what we call stalwart, rapid, and cyclical growth companies. We explain more about this in our annual report on the website, but in principle, look to manage the portfolio that is balanced across these three growth types. Our belief is that share prices follow fundamental progress in earnings over long periods. Therefore, our objective is simple: to be long-term holders of growth companies and let the power of compounding drive returns. Our shareholders are our number one priority, and so we seek to keep costs low. As assets grow, fees will fall, maximizing returns for shareholders. Our borrowing costs are low too. The average borrowing cost for Monks' debt is 2.7%, a low hurdle when set against the growth that we believe we can deliver over the long term. Finally, we have been active buyers of our own shares. Monks has continued to trade at a discount to its net asset value, which is the value of its assets minus its liabilities, in the past financial year. During this time, we have bought back around 7% of its issued share capital, which is amongst the highest in its sector. In the 12 months to the latest financial year end, April 2024, we have delivered a return of just under 18%. While this is 1.5% behind the global index, we believe there is much to be optimistic about. We see strong evidence that many companies in the portfolio are executing well. Indeed, the combined increase in their earnings for the year was just under 12%. Amongst the strongest performers in the portfolio were Martin Marietta and CRH in materials and building supplies. Meta, the social media business, which has successfully grown demand for its advertising capabilities and delivered record profits. And DoorDash, the leading online food delivery business. The latter is successfully building out a last-mile delivery network that we think will make it the envy of many and support a growing ecosystem that will become the convenience platform of choice for consumers in the United States. Now, on the other hand, our exposure to insurance businesses and a selection of healthcare companies was a headwind for performance. For the former, the lingering effect of the pandemic has weakened Chinese consumer demand and made it difficult for companies to actively sell insurance products in the region. We have retained a position in insurance company AIA, but decided to move on from both Prudential and Ping An Insurance. The backdrop for healthcare businesses has been very challenging. Excess inventory built up following the pandemic, which has suppressed demand. And a much more difficult funding environment for drug developers has made it difficult for some holdings. Royalty Pharma, a provider of capital to drug developers, has seen its share price fall. Yet we continue to believe that operational progress is on track. Its stream of royalties from its existing portfolio of drugs continues to grow healthily, and the company is investing heavily in its future growth. For example, in the last quarter, it spent $1.6 billion. Now that compares to an average of $2 billion annually over the last 5 years. Elsewhere, we have sold our shares in Novocure, which suffered disappointing results from a late-stage cancer treatment trial. While markets have been narrowly focused over the past year, we have continued to embrace a wide array of opportunities and believe the portfolio is well balanced across our three growth profiles. Importantly, our portfolio holdings are aligned with deep structural changes in economies and societies that we believe will be a helpful tailwind for growth in the years to come. Let's highlight three to illustrate what I mean. First, digital payments. The value of global digital payment transactions is growing fast. It has doubled to over $6 trillion in the past 5 years alone. And we believe that there remains much to go for. We have purchased a new position in Block, which owns Cash App, the most popular finance application in the US, and it owns Square, the point-of-sale hardware that enables small merchants without an online presence to accept digital payments. We are excited about Block's potential to integrate these two offerings and build significant long-term value. The portfolio has exposure to a range of other digital payment businesses. These include MasterCard, Adyen, the Dutch payments business, and the rapidly growing Mercado Libre in South America. Second, the excitement around the potential for artificial intelligence, or AI, is to a large extent underpinned by the technological advances in semiconductors that are driving the exponential acceleration of computing power. We have deliberately grown the portfolio's exposure to the semiconductor industry. It is now 10% of the portfolio over the past couple of years. We purchased shares in NVIDIA in June last year as the leading global designer of graphics processing units, a key enabler of AI applications. And we haven't stopped there. We have recently added holdings in semiconductor companies Texas Instruments and Samsung Electronics. Growth in both cases will be driven by the secular trends towards greater electrification, for example, in the car market. The use of consumer electronics, think smartphones, tablets, and laptops, and the ongoing build-out of data centers to support increased cloud computing capacity. Finally, we have continued to invest where companies may be beneficiaries of an infrastructure upgrade, particularly in the US. Now, there are several factors here, including reshoring trends and infrastructure spending supported by legislation like the Inflation Reduction Act, which are likely to support a material uptick in capital spending on areas such as roads, energy, and digital networks. We recently established a position in the Canadian company Stella Jones. It is North America's largest manufacturer of pressure-treated wood products. The growth case rests on its core product, wooden utility poles that literally hold up the electric grid. They are used for both electrical and for communication infrastructure. For the US to decarbonize its energy systems and have a chance of achieving its net zero ambitions, substantial investment will be required in its national power grid. We believe volume growth and pricing power will boost profitability in the coming years. Across our portfolio, companies are successfully fine-tuning their operations to the present while continue to invest for the future. Monks has delivered strong earnings growth. Importantly, forecast earnings growth in each of the next 3 years is higher than the FTSE World Index. There are encouraging signs that the investment markets, against a backdrop of stabilising inflation and interest rates, are more willing to recognise this, and that our performance against the benchmark has begun to rebound sharply. We look forward. What is most exciting is that the rate of change and technological development is accelerating and underpins a growing and often underappreciated opportunity set. By virtue of our willingness to take a wide-angle view of growth, we have the latitude to invest beyond the obvious. This allows us to harness the growth potential of lesser-known but exceptional growth companies. Our portfolio reflects an eclectic and growing opportunity set that we are confident can deliver for shareholders in the years ahead.